Welcome to The Explainer. You know, a company's earnings report, it can feel like this super dense financial puzzle, right? But buried in all those numbers, there's actually a story about the company's health, what it really cares about, and where it's headed. So today, we're going to give you the decoder ring.
And for our case study, we're going to use Diamondback Energy. Now, these guys are a huge player in the U.S. oil and gas world, based right out of Texas. So let's do it. Let's crack open their latest financial report and see what we can find. I mean, let's be honest. Staring at one of these things can be pretty intimidating. So what we're going to do is break down their fourth quarter results for 2025 step by step, and I'll show you exactly where you need to look to find the stuff that really matters.
Okay, so here's the game plan. First, we'll do a quick financial checkup. Then, we'll look at the real engine of the company, its wells and production. From there, we'll decode the bottom line, figure out how shareholders got paid, and then we'll take a look at what they're planning for 2026.
Yeah, the best way to think about an earnings report is like a regular checkup for a company. It's not just a quick snapshot of the past few months. Nope. It's more like checking its vital signs, giving us clues about its overall health and, where it might be going.
So to really get a handle on any company, you've got to start with what it does. What does it make? For a company like Diamondback, it all starts with what they're physically pulling out of the ground. That stuff is the starting point for all the financial numbers we're about to see.
Okay, before we get into the weeds with the numbers, we got to decode some industry jargon. You're going to see this, MBOE/D. It just stands for 1,000 barrels of oil equivalent per day. Really, it's just the standard way they combine oil and natural gas production into one single number so you can compare apples to apples.
So what did that actually look like for the last quarter of 2025? Get this. Diamondback pumped out an average of over 512,000 barrels of oil equivalent every single day. That is just a staggering amount of energy. It's the literal heartbeat of their business.
And this table here? It shows you the sheer amount of work that goes into getting that kind of production. I mean, look at it. In just 3 months, they drilled 100 new wells and actually completed or brought online 121 of them. This isn't a business where you just sit back and watch the money roll in. It takes constant, heavy investment to keep this machine going.
All right, so we've established they're producing a ton of energy. But the big question is, did they actually make any money? Let's jump over to the financials and see how all that oil and gas turns into cold, hard cash.
And bam! Right away, we hit one of those head-scratchers you find in these reports all the time. On the one hand, you see revenues of almost $3.4 billion. That's a massive number. But then, you glance down at the bottom line, net income, and it says they lost nearly $1.5 billion. What? How does that even happen?
So yeah, how on earth does a company bring in billions and then report a huge loss? Did they actually lose that money? This is probably the most common point of confusion, and the answer gets to the heart of reading these things. It's all about the difference between what accounting rules say and what's actually happening with the cash.
The big reason for that loss is something called an impairment charge. And in this case, it was a whopper, $3.6 billion. Now listen closely, because this is the most important part. This is not real money that left their bank account. It's an on-paper, non-cash accounting adjustment. Basically, because of things like changing energy prices, they had to legally reduce the value of their assets on the books. It's an accounting thing, not a cash thing.
And it's because of these weird accounting rules that smart analysts usually look right past net income and focus on a much more useful number, free cash flow. Think of free cash flow as the real story. It just cuts through all the accounting noise and tells you how much actual spendable cash the company made after paying all the bills and reinvesting in itself. It's the true profit.
And here it is. This is the number that matters. When you ignore that on-paper accounting loss and just look at the cash, Diamondback actually generated a full $1 billion in cash profit. $1 billion. That tells a completely different and way healthier story than that scary-looking net loss.
So, $1 billion in spare cash, that's a pretty good problem to have, right? But what do you do with it? Well, that's the next chapter of our story. And for Diamondback, a huge piece of that pie went right back to the people who own the company, the shareholders.
And this chart right here, it just lays it all out. It makes their priority absolutely crystal clear. A massive 62% of the cash they generated went straight back to stockholders. That is a huge signal to the market about how much they're focused on rewarding their investors.
So how did they pull that off? Well, they had a 3-part plan. First, stock buybacks. They spent over $400 million buying up their own stock, which makes every share that's left just a little bit more valuable. Second, they basically gave shareholders a raise by increasing the dividend. That's the direct cash payment you get. And third, they used some of that cash to get their financial house in order, paying down more than $1 billion in debt.
You know, a good earnings report doesn't just tell you what happened. It also gives you a peek at what's coming next. In the financial world, they call this guidance. It's basically the company's official forecast for the year ahead.
And looking at their guidance for 2026, the big word seems to be stability. They're planning to keep production right around that same level, about 500,000 barrels a day. And to pull that off, they're planning to plow somewhere between $3.6 and $3.9 billion right back into the business.
This quote they put in the report really helps you grasp what that investment means. They're expecting to complete between 5.9 and 6.3 million feet of lateral drilling. To put that in perspective for you, that's more than 1,100 miles of drilling. That's like drilling from Dallas all the way to Chicago. It's just an insane amount of work.
And really, that brings us to the core challenge, the ultimate balancing act that you'll find at the heart of every single earnings report. What we saw with Diamondback was a company making tons of cash, focusing on getting it back to shareholders, but also spending billions to make sure the business is still running strong tomorrow. And that's always the central question, right? How do you keep investors happy today while also making sure the company is built to last? And now you've got the tools to pick up any report and find that story for yourself.